Good morning and welcome to another edition of the Main Management Weekly Market Note for the week ended February 27th. We're now into March, third month of the year. On the year-to-date basis, things are more positive than negative. It might not feel that way, especially after the weekend's events with the developments in Iran. You've seen some, on there quickly, just oil prices spiked, VIX spiked, futures were down, but things are kind of equilibrating already.
Yep.
I think oil was up as much as 13 or 15%, back down to 8, maybe even down to 5. So kind of things quickly equilibrating as the reality kind of starts to sink in rather than just the knee-jerk reaction. For the trailing week, more sectors up than down. Utilities, staples, healthcare, clearly kind of a defensive play there. Commodities up as well. Gold and silver still kind of driving there. Fixed income. So you're seeing, again, a little bit more defensive positioning, that kind of continued ongoing rotation. We'll see this in the data as well. Recession dashboard, not a ton changed to close out the month. On the macro data, it was a weird week, not a ton of really big releases, just a lot of kind of little kind of smaller pieces here. But the biggest one was the producer price index PPI, which surprised to the upside. The overall index that's shown on the left there in light blue was up basically 0.5% month over month, well above forecast for a 0.3% increase. The year-over-year figure did slow to 284 on easier comps. Things have been kind of trending sideways. Core on the right really jumped 0.8% month over month. It's the biggest since March of 2022 and is now up basically 3.6 year over year. Hotter than expected. I think this is going to give some people a little bit of pause for those claiming that inflation has been tamed. Again, these producer prices tend to feed into consumer prices. So we'll see if CPI and PCE come in higher as a result on the lagged effect. But certainly, this was a kind of a little bit hotter than expected, and it'll give folks a little bit of cause. The driver, as we show on the left, was services. Goods on the right, outright deflationary month over month. They're down to 1.5, which is the lowest since last May. But services on the left jumped 81 bips month over month, and that's up 3.4 year over year. It's the highest since July of 2025 and has been kind of accelerating over the last couple of months. So we mentioned goods on the right were deflationary. Energy and food helped there. Energy was down 2.8 and food was down 1.5 month over month. But again, that services is really kind of driving things higher.
I know we talked about this a little bit last week, actually on one of our calls, but it was, services obviously isn't going to be affected as much by something like tariffs. So what is driving that number higher? Is there one thing, or is it kind of just a broad-based increase that you've seen at least?
I think it's been broader based. You saw stuff like it's margins. I think companies are, and this also kind of goes to show that it felt like for a while people were wondering when the tariff effects were going to show up. And I think companies were kind of saying, all right, we'll maybe eat this for now, but maybe that point is done where the services side has kind of gotten to the point where they're just like, all right, we're going to start passing this through because it's hurting our margins for a longer time than we thought. But it's been pretty broad. I don't think it's been in particular. But I saw, the release was noted that margins were kind of the bigger reason for that, which companies is protecting their profits. We got construction spending as well. That was up call it 3% month over month, basically in line of forecast and reversed 3 straight months of declines. That dollar figure on the right is kind of trending sideways at $2.17 trillion, but it's now improved to minus 0.4 year over year. So it's the least negative since last January. Really, private sector spending drove the headline figure up 0.5, while public sector spending fell 0.7 month over month. So good to see kind of that private, as we like to say, the capital allocation is generally more efficient on the private side of things rather than the public government side. We got the home price indices. This is the S&P Case-Shiller 20-City Home Price Index. That was up 0.5% month over month and the 5th increase in a row. It kind of seemed like we were getting a little bit of a dip there. You saw 5 months in a row just to turn around and go right back up in an even stronger manner. So on the right, we show the index itself. It's up at a new all-time high at 343, and it's up 1.4 year over year. Again, that's still relatively muted. If you take out that kind of COVID distortion correction there, that goes back to basically the lowest figure since coming out of great financial crisis like 2010, 2011. And you'll see a similar on the next slide when we address it. But something that's interesting is there was a report that came out from Redfin where they're in the market now, 44% more buyers, or sorry, 44% more sellers than buyers. So an absolute difference of 600,000 more sellers than buyers. The second largest gap on record dating back to 2013. What's the cure for prices? High prices, high prices. And I think not only is that gap the highest, but the number of buyers in the market is at a record low.
How are prices in your eyes staying high or even, moving up month over month with so many more sellers than buyers? Is it just like a lag between?
Yeah, and I think sellers are they're not cutting prices yet.
Yeah.
They're going to let their houses sit basically until they can't tolerate it anymore, and then they'll start cutting, but they don't want to if they don't have to. And right now, I think the market is confirming that that sellers have not yet started to drop prices. And I think it's the sort of thing where, if you look at like the way kind of neighborhood turnover occurs, where as soon as one house changes hands, then it's kind of a flood. And so you'll see maybe here, once somebody sees, oh, that person cut their price by a little bit, and they sold, oh, maybe I can cut it by a little bit and get away. And then all of a sudden it kind of cascades. So we'll see on that. But I think, the dynamics are certainly shifting, and now you've got more 6% than 3% mortgages. Although, to be fair, that's above 6 and below 3. It's still only 20% of the mortgages are, 80% of the mortgages are still, lopsided in favor of lower than they are now. So there's still friction to move through. But again, that FHFA home price index also up, a more muted 0.15 month over month, third increase in a row in the last 5 months. It jumped 70 bips in November. That's the biggest since February of 24. And then, on the right, we show the index again, similar to Case-Shiller at all-time highs, 440 on the index level, but it's now up just 1.8% year over year. That's the smallest since March of 2012. So the increases are slowing, but again, this is like inflation where the rate of change is slowing. The prices are still going up on an absolute basis. But I think, there's at some point here, it's hopefully, I don't know. I think at some point, if you want to sell a house, you're going to have to drop a price. Because the buyers are clearly not showing up, and you have to entice them back in somehow. On the inventory side, wholesale trade on the left there, that overall figure is represented by the black bar, was up 25 basis points month over month in December. Durable goods were up 36 bips, their biggest since March of 25. Non-durables were up just 0.05. That's the smallest build in 4 months. Year over year, they're all accelerating. Total inventories are up to 2.95% year over year. That's the highest since May of 23. Non-durable goods are up 4.76, and then durable goods are up 1.87. So those are all kind of accelerating higher to multi-year highs on a year over year basis. The regional Fed manufacturing indices are, again, we're a little bit of a data desert last week, but the February was a good month for them. On the left, we show the current activity indices. Kansas was up the most on a month-over-month basis at plus 5 points. New York, Empire, and Richmond declined, but the simple average still was up 1.1 to 3.7. That's the highest since Jan of 25. And then for the future indices, only Dallas was down month over month. Philly was up 17 points, leading that simple average up 5.8 points to 25.4. Also its highest since January of 2025. So kind of starting to see some signs of life in these indices. But on the right, on the future indices, all above zero. So that's a good sign. On the left here, we show the simple averages on their own, so in isolation, as opposed to having kind of the 6 lines on there, but for a little bit more clarity. And you can see they're both pretty clearly in uptrends that began for a future activity back in October of 22 and in current activity January of 24. So we're now, over 2 years into that current activity and 3+ years into that future activity. So it's good to see them both above zero and kind of grinding higher. On the right, you show the prices paid and prices received. And it's been good to see those decline as well. They kind of, came off the tariff boil, or sorry, the COVID, kind of supply chain boil, and then, muddle along, and then tariffs hit. And you can see very quickly they pop back up on tariffs, and now we're starting to recede again. So it's, it's good to see. You don't love to see the prices paid jumping on the tariff issues. I think, people are pretty clear that tariffs aren't great for trade in general, but you're starting to see that abate a little bit, which is a good sign. We got the sentiment on the sentiment side of things. The Conference Board Consumer Confidence Index ticked up to 91.2 from an upwardly revised 89 in January. Expectations hit 72. Present situation moved lower to 120, but that's its lowest since March of 2021. So I think, you're seeing people still not feeling great about their current situation. But it's, overall things are kind of, I don't know, maybe starting to pick up a little bit. The sentiment still is tough here. The labor market differential, that's the percent of respondents citing jobs plentiful, less percent of jobs hard to get, ticked up to 7.4 more for jobs plentiful. But again, that's in that kind of multi-year normalization downtrend. It's also worth noting this has been negative historically. Historically, there have been, on median at least, but you can see this thing does go in big cycles. It rarely treads water sideways. It's either going up or going down. But generally in history, there have been more people saying jobs are hard to get than people are saying jobs are plentiful. So this is still kind of in positive territory here, normalizing. In summary, that PPI came in hotter than expected. Core and headline both jumping 0.5 and 0.8 respectively. Services are the driver there. Construction spending in line with forecasts. Home price indices both increased in December. No signs of weakening there. We'll see if that continues to play out. If so, for how long. Wholesale inventories were up in line at 0.3 month over month. Good start to the month for February manufacturing indices on the regional level. And we also got the manufacturing PMIs today, actually, and those were more up than down. The U.S. posted its 7th straight month on the S&P headline figure, so that's good, solid expansion for the manufacturing sector. And then you saw consumer confidence tick up, but again, kind of still muted, and that labor market continues to normalize. This week, we get the PMIs, as we mentioned, both manufacturing, service, and composite. Then on Thursday, we got productivity, unit labor costs. We got job cuts in here as well. And then the big data day is Friday, really, with retail sales, and the big one is non-farm payrolls. I think some of the figures I've seen are, around 60,000 for non-farm payrolls, so solid gain there. But again, we'll find out as we move through the week. So thank you for joining us, and hope your Monday is going well. Thank you.
Thank you.